September 28th, 2023. You can see today we got an attempt at a wedge, 1, 2, 3, and we ended up breaking out above the wedge. When you get a breakout above a wedge, oftentimes it leads to a measured move the height of the wedge. You can see we got one attempt down, second attempt down, third attempt down, and all three failed. So when you get the big bull breakout on 23, I think it's pretty reasonable to take the buy above 23, hoping that you're going to get the measured move up. Additionally, some bulls will exit below 22 since it's an inside-inside pattern, right? Inside bar 21, inside bar 22. When you have IIs, they often lead to breakouts. And so that's why it's a reasonable attempt at a wedge. And when the wedge fails, a lot of traders who exited below 22 are going to be buying back their longs in a panic above 23, hoping they don't miss out on a swing. And so, that's a big reason why we rally. And that's the big reason why, when you get a breakout above a bull flag or above a bear flag, you can expect it to rally for a measured move. Additionally, you can see bears who sold above the high of 20. So they sold the breakout because you can see over here, they sold the breakout and they made money. So they sold the breakout again, expecting to make money, and the tail of 24 never let them out. And so traders who sold above this high were disappointed by the close of 23, and then 24 rallied, and a lot of them exited above. Other traders sold above that high, and they sold more on the close of 23. If you sold that high and sold more on this close, you can see your break-even price was right there where the tail of 24 hit. So they sell here, they sell more here, and they get out at exactly break-even. And this all fuels all of this buying. Like I said, some traders get out here, some traders wait and get out up there. Additionally, this sell-off at the end of the day looks random, but it's really not. You can see the low of bar 39. If you bought below 39, you probably should make money. And you can see how disappointing 40 and 41 would be if you bought below 39. And so what happens when we get close to it within a tick or two on 72, the market sells off immediately, because if you bought below here, you're super disappointed in this. So maybe you buy more here and you're going to get out as close to break even as possible on that first trade. And so that's what's happening here. This is just bulls getting out of longs. And any bulls who bought for any reason during this are extremely disappointed by 73, and they're panicking out as well. And that's what causes the big dump bar in 74. And while 73 and 74 look really strong for the bears, the reality is this is just bulls getting out from over here, and this is bulls getting out below 73. So this is just bulls panicking out. This isn't necessarily bears selling. So while it might look tempting to sell down here, the reality is this is just a sell climax from this buy vacuum. For that exact same reason, you should be, pretty cautious tomorrow if we get to the 72 low. I think personally that if we get to this low tomorrow, there will be a lot of sellers up in this area. So I don't know what the gap is going to look like or anything, but I do think that if we start to rally earlier in the morning, you should be careful around this low. Additionally, if you look at higher time frame charts, so if you look at, let's look at the 30-minute, you can see that yesterday we got a strong bull breakout at the end of the day, which was probably enough to get a second leg up. And so coming into the day, you know that this strong bull breakout was likely to lead to a second leg up. And you can see it was a strong breakout and it was a two-legged correction. The correction was exact. So leg one, pull back, leg two. Sorry, it's not snapping properly. There we go. So it was a leg one, leg two correction. So strong spike, two legs, and then a second leg up. I don't know if the legs were even in size. I'm just going to check. Doesn't look like it. Maybe if you use tails, it doesn't really matter, but they were close. Maybe if you really want to stretch your luck, you could say something like this, but it doesn't matter. Come on. It doesn't matter regardless. But I just think that sometimes it's cool to look at. Yeah. See, look, like if you use the low of this, which is technically, I guess, where the leg started, you get one, pull back two. It doesn't matter. But what matters is coming into the day knowing that we're probably going to get a second leg up from that rally. And so that's what's really important to pay attention to. We have a strong bull bar closing near its high on bar one, but it's probably not all that strong. I'd rather wait for follow through before buying. It is, you are bullish on the day in general, but I'd just rather wait for follow through. Bar two, bear inside bar, but a big tail on the bottom. And bar three gets below the bar one low, but the bulls who buy below one are probably going to make money. Additionally, bar two goes down, up, and then back down. So what it really is think about what down, up, down means. It's a two-legged correction. And so two, pull back, three is actually a two-legged correction on a lower time frame. Four is an inside bar and it's a double bottom with one, but doesn't close that strong. Big bull surprise on 5. I think 5 makes the market clearly always in long, and so it's reasonable to buy looking for a swing. But it's a swing trade, so it's lower probability, right? It's an always in flip. I'm not sure we necessarily ever went clearly always in short, but it's a clear always in long bar. So bulls will buy above 5, hoping that we're going to get a measured move up. They get follow through on 6 and follow through on 7, but we're just kind of seems like a vacuum test of this close. The bulls who bought here did something reasonable, and they should get out at break even. So I think 7 is just a vacuum test of this close from yesterday. You can see that's why we find sellers on 8 and 9 there. I think 10 is, as also, by the way, so if you bought the close of 7, you're disappointed in 8. You can see on 9, those traders are exiting pretty much exactly at break even. 10 is an interesting bar. It's extremely disappointing because there's a large tail on the bottom, but it's probably going to be, it is probably big enough to get a second leg down, but it's not clearly always in short. 11 is disappointing for the bulls as well. You get a big tail on the top. And so bulls see this tail and know that a second leg down is likely. So when they get this rally, they just take it as a gift, and a lot of them exit out of their longs, and you get bar 11. But it also doesn't close near its low. And 12 is kind of bad follow through for the bears. So the bears aren't doing enough to convince me it's a bear trend day. This is still the dominant feature on the day and the strongest spike, but there's a lot of problems with it, because if this is going to be a bull trend day, this probably shouldn't be happening if this is going to be what leads to a bull trend day. And then 13 essentially is a vacuum test of the open of the spike. I think bulls, always in bulls, can exit below 11 and look to buy again lower, or, above a bull bar, closing your tie, maybe 14, maybe 15. But I don't necessarily have to exit. It's never clearly always in short. It's a lot of bear bars. It's 6 bear bars, so that's a problem. But I just don't think it ever clearly went always in short. So you don't necessarily have to get out. 14, it's double bottom of 5. It's an okay swing buy, but I'd rather wait for follow through. If it's going to be a bull trend day, you're going to get a lot of bull bars, and this is a lot of bear bars. So I would just rather wait and see what you get on the next bar before looking to buy. And you get good follow through on 15. So I think you can buy the close of 15. It's kind of like buying the close of 5 in a lot of ways. I think that it's a swing buy, so it's lower probability. And this is kind of a big problem for you if you're buying, and it's because it's the top of the trading range. But you're not buying 15 expecting that we're probably going to get a swing. You're thinking that we might get a swing. So maybe it's 40-50% that we're going to get a swing. I think a stop below 15 is just fine. Theoretically, a stop below 13 is where it should be. But a stop below 15 is fine, because realistically, if you get a bear bar or two, you're just going to get out because your premise isn't valid. You get followed through on 16, 17, and 18. Bear bar on 19. It's not clearly always in short, so I wouldn't exit below 19. Big outside up bar on 20. There's a 90% chance we break out of the 18 bar range every day, so not surprising we get the outside up bar on 20. Inside bar 21, 22. We talked about an inside pattern, a potential wedge, a potential nested wedge. 1, pullback, 2, down, up on 21, and down again on 22. So that's 3 pushes. It's an inside pattern, like I said, so I think you should exit below 22 if you're long, but you have to keep in mind, if this goes outside up, it's okay to buy back your longs above 22 or above 21, thinking that we might get the swing up. And it's definitely okay to buy the close of 23, hoping that we're going to get a measured move up of this wedge. Follow through on 24 and 25. Good bars for the bulls. And again, it's very noticeable that you have an open gap with this high and this low. That's extremely important. It means bears can't make money. And if bears can't make money, then, they're going to be exiting. So bears are exiting. 26, bear bar, which is a problem for the bulls, but it's just a doji. When you get a doji and is by the close trend, generally that means that the market's probably going to go sideways within 3 bars. Also, with this, whenever you get a swing trade, a lot of times the market will do something to try to trap traders out. And that's exactly what it did here. You can see that 19 trapped out weak traders, but 22 might trap out some strong traders. And, the market does this a lot, and it makes sense that it does it, because in order to trend, it needs trapped traders. And so when it traps, bears into selling here and traps bulls out of buying, that's why you get a big bar on 23 and all this panic follow through buying, is because you have traders, bears trapped in who sold below 21, and bulls who exited below 21 now trapped out of the trend. So that's why traders are buying above 23, 24, 25, etc. So 27, big bar for the bulls, but we're probably going to pull back this high. We get follow through 28, 29, and a pullback on 30, 31, 32. 3 straight bear bars in a row is more than you would like if you're a bull, and this is a buy the close bull trend. Generally 1 or 2 is fine, but when you get 3 bars in a row, that's probably more than you would like it to be. So disappointing a little bit. High 1 on 33, low probability. You get follow through on 34, but in reality, it might just be a vacuum test of the 29 close. You can see we tested it on 35, and that's where we sold off a little bit there. And a big bull surprise on 36. But if you look at 36, it's one of the best looking bull bars in the entire trend, and it's coming, 20 plus bars into the trend. So probably exhaustive, and we're probably at least getting back to this high. You can see 37 pulls back to the 35 high before it finds buyers. Although 36 wasn't a great buy, it's a reasonable buy the close bar. And so it's reasonable to think that we're going to test the close. And that's exactly what we did. 38, 39, we test the close. Any bulls who bought the climax of 36 were essentially hoping that we were just going to race up. We were basically trying to break out of this channel line. And if we had succeeded, we would just get, a huge buy the close rally, maybe 5-10 bars, and those bulls make a windfall profit. Bulls know that's unlikely. There's only maybe a 30% chance of that happening. But, they also know that if it goes down, it's probably not going to go very far because this is all pretty strong and should get a second leg. And so if they buy the close at 36, they'll probably buy more, maybe at the 35 high. And then during 39, they'll get out at break even on their first entry with a profit on their second entry. And all those bulls selling out of their longs is what's going to cause 40 to close near its low. Bears get follow through on 41, but, I think that 40 is bulls exiting high, and then 41 is bulls, selling out of longs below this. I think always in bulls are going to exit below 40. It's a big bear bar. We're probably at least getting to the moving average and going to try to form some sort of gap bar. So you're probably going to get it. You're probably going to get an opportunity to buy lower. So that's why I think a lot of traders will exit below here. So you get follow through on 41, 42, just a pullback because, like I said, anyone who is, this is just bulls exiting around break even. That's what's causing this. And bulls exiting below is what's causing this. So when there's no bulls left to be selling, that's why you get a bounce here. Low one short below 43, but it's a tight trading range. I don't think it's very good. And you have to keep in mind, this is the dominant feature of the day. This controls the remainder of the day. So I would need, really, really convincing price action to want to sell. And we need to go sideways for quite a few more bars. Basically something turning down from the 39 low. I probably wouldn't sell this, but that's kind of the thing that you have to be looking to sell on this day if you want to short at all. 44 is a double bottom. We're probably going to get back to the 39 low, but if you buy above 44, you're disappointed in 45, and you probably just get out of break even during 46 or 47. And that's one of the reasons we get a big dump on 48, follow through on 49. That bulls who buy below this low, the 44 low, are probably going to make money. So it's not surprising that 50 pulls back and allows those traders out. But they're still disappointed in 48 and 49. So a lot of them sold out, and that's what causes the bear bar on 51. Bull bar on 52, but not quite closing on its high. And bad follow through on 53. You're basically looking for a gap bar to get back to the 39 low. So, everyone knows it. So you're just kind of looking for a strong bull bar closing near its high to get back to this low. You should have some concern that traders, who bought below 47 haven't gotten out yet, and they're disappointed in 48 and 49. So there might be some sellers when we get back to this low. You have to keep that in mind. But in general, everyone's looking to get back to this low. 56. It's okay to buy above 56 for a swing. Good follow through 57. I think either one of these is a completely reasonable buy. It's 2 legs down, so you might get a third push. You can see we ended up getting 1, 2, 3. So we got a wedge down and an okay buy above 66. But 57 is fine too. You get bad follow through 58, bear bar 59, and then you get 60. I think, if I bought, I would probably just end up exiting below 61. And oftentimes, this is a trading range now, and trading ranges like to trap traders out. And so you can see 62 trades just below 51. There's probably buyers below 51, but the reality is if you bought in here, your stop's probably down here. So it's not that surprising that we trade right below here and then reverse up, and that traps a bunch of traders out. And the traders being trapped out is what's going to cause this rally. So 60, 61, big bear surprise, probably enough for a second leg down, but you got to be cautious selling. A third leg down, 1, 2, 3. You're selling a third leg down in a trading range, so it's probably not all that good. And you can see anyone who sold just scalped out with 5 points. What's the low of this? 33.75. So it needed to get to 28.25. And, it got a little bit past that. Or is that right, math? I think it's right math. But yeah, you can see those those bears were able to make 5 points. Um, and we got a reversal up. Try and test the 60 low, second leg down 64, and then rally on 65 and 66. 65 is a double bottom, and it's 3 pushes down. Some traders might buy above 65, but I think with the failed gap bar, I'd rather wait for follow through. 66, good bull bar closing near its high above the moving average, really strong buy. Good follow through 67. Doji on 68, but okay to hold long. Follow through on 69, 70, 71, etc. But you can see that the bodies are shrinking 71, 72, and there's a tail on top of 70. So the best looking bar was probably 66 and then 69, and the bodies got worse. So it's a sign that momentum is waning, and you know you're right near a low where there's going to be a lot of profit taking. So a lot of traders might just exit on the close of 72, and that's part of what's causing this. And I already talked about that. A lot of times, I think if you're managing, if you buy above 57 and you see 59, a lot of traders will be getting out as 61 is turning down, or a measured move down of 60, or somewhere in here, maybe. And you don't really have to take the full loss. I think it's okay to get out below 61 and just look to buy again above a bull bar. Really good traders, might get out around break even here, but I'm definitely not there yet. Going back to higher time frames for a second, you know, this, I'll just go to the 30-minute. That's what we looked at earlier. Why not? So just as this was strong enough for a second leg, this might be strong enough for a second leg. I think we're at least going to test this close. This is 2 legs down, so we probably should test this close tomorrow on the 30-minute at least. I think this is not Globex included. Yeah, it's not. So I wouldn't be surprised if we bounced up here tomorrow and tested that high. Again, I would be cautious tomorrow being long at this low. Looking at the daily chart, I've been saying for a few days, I've been thinking we're going to bounce and probably get back to this low. And we did. We got back to that low and that low. So limit order bulls who bought here and bought more lower have now made money. Why is that significant? Because it means the bear trend is not as strong as it could be if limit order bulls are able to make money. In a really strong bear trend, bulls aren't able to make money at all. So this trend might not be as strong as bears would want it to be. On the weekly chart, tomorrow's Friday, which is the last day of the week, so you have to be open to a big move. I think tomorrow is going to be really important, and we're going to fight over the close of this bar a lot. So I would pay a ton of attention to the open of this bar tomorrow, and see if we get a vacuum test of it towards the end of the day, because I think bears got follow through here, but they want confirmation, and it doesn't seem like they're going to get strong confirmation, but they want some sort of bear close to confirm that it's somewhat of a bear trend. If this is a bull close tomorrow, then it might be a bear trap, and we could rally. So I think that the close of this bar tomorrow is going to be really, really important, and I would just pay a lot of attention to it. All right, that's the day.